Welcome back to the deep dive. We're your shortcut, really, to getting under the hood of complex financial reports and figuring out what's actually driving the markets.
That's right.
And today, we're zeroing in on a big one, the Indian cement sector. We've plowed through a whole stack of Q2 result previews, channel checks, basically everything covering July through September of this financial year, FY26.
And our goal here for you listening is to cut through that noise. We want to map out the short-term, let's call it turbulence, and also unpack the bigger long-term shifts happening in this industry.
Because it is complex, isn't it? You've got the usual seasonality issues, plus this year, major policy stuff like the GST rate cut thrown into the mix.
Exactly. It's not enough just to read the headlines. We need to dig into what's really driving profitability, or sometimes the lack thereof.
And the first thing that just leaps off the page from these reports is this. Well, it's a paradox, isn't it? Q2, July to September, it's always the weakest quarter. Seasonally, construction slows right down. This year, it got hit even harder, extended monsoons, demand was a bit soft, and then this pricing wobble because everyone knew the GST change was coming.
Right. A perfect storm, almost, for a weak quarter.
But then you look at the analyst forecasts, and they're predicting these massive year-over-year profit jumps, huge rebounds. We're talking EBITDA per ton figures, potentially surging 50, even 70% for the companies they cover.
And that contrast, that tension, that's really the heart of our deep dive today. It feels like the sector is, as one report put it, taking a step back to leap forward.
That's a great phrase for it.
And to really get why a 50 or 70% jump is so significant, we have to focus on that key metric, EBITDA per ton. It's the standard measure, right? It tells you how efficiently a cement company is running its operations, regardless of its size or where it's located.
It cuts through the noise of just looking at total profit.
Precisely. And this huge surge isn't just about things being okay now. It's about how incredibly tough things were in Q2 of the previous financial year, FY25. They're climbing out of a really deep hole dug by intense competition back then.
Okay, so context is everything here. And we've built this picture by looking at reports from several key players, Axis Securities, ICICI Securities, Systematics, Yes Securities. Quite a range.
It's a good cross-section, yeah.
So let's use their data to show you why things look weak if you compare Q2 to Q1, but actually quite strong when you look year over year. First up, volumes. Let's unpack the demand story and those seasonal headwinds.
Right. So Q2, it's the lean season, no getting around it. The monsoon hits and construction just slows dramatically.
Yeah, you can't pour concrete effectively in the pouring rain, can you?
Exactly. Setting, curing, it all gets disrupted. Plus, logistics become a nightmare. Wet roads, delays. Many project sites either shut down completely or just operate at a crawl. Historically, Q4 and Q1, the post-monsoon and pre-monsoon periods, those are the peak times.
And the numbers for Q2 FY26 definitely show that seasonal drag. But there's a bit of a range in the estimates, which is interesting. Volume growth year over year. ICICI Securities had it pegged at maybe 3 to 4% for the companies they cover. But Axis Securities was a bit more optimistic, suggesting maybe closer to 8% year over year growth. Why such a difference?
Well, that variation probably comes down to the specific companies each brokerage is focusing on, their coverage universe, as they call it.
Okay.
Some might be tracking companies more heavily exposed to, say, the north, which maybe saw a less severe monsoon, or perhaps companies with a bigger share of government infrastructure projects, which tend to be a bit more resilient.
Right.
But either way, whether it's 3% or 8%, those growth numbers are, well, they're not exactly stellar, are they? Especially considering they're being compared to a relatively weak Q2 last year. We might have hoped for a bit more, frankly.
So what specifically held things back this time, beyond just the usual rain? You mentioned a few other factors.
Yeah, there were a few things compounding the issue. We definitely had an extended monsoon, particularly hitting the east and south quite hard.
Okay.
Then there was the Shroud period. It's traditionally seen as inauspicious for starting new things, including construction, so that tends to defer some demand, especially in central and northern India.
Right, a cultural factor.
But the really big one this quarter, the short-term dampener, was absolutely the anticipation of the GST rate cut.
Yes.
Everyone knew it was coming towards the end of September. So if you're a large buyer, institutional project manager, a big dealer, why would you buy in August or early September when you know prices are about to drop significantly because of the tax change?
You'd wait. Simple as that.
You'd wait. So a lot of demand got pushed out, postponed, just waiting for that tax relief to actually kick in.
So ironically, the good news post, the tax cut actually created some short-term pain by suppressing demand within Q2.
Hmm.
Interesting.
Mm-hmm.
But even with builders waiting and the rain falling, demand didn't completely collapse. What was holding it up? What provided that floor?
Well, that's the constant, reliable engine in the Indian economy right now. The
Mm.
government's infrastructure push, that continued capital expenditure, or CapEx. It's still the main volume driver.
It papers over cracks elsewhere?
It really does. It compensates for softness in other segments,
Yeah.
and we see proof of this steady flow in the core sector. Data cement output was still up 8% year over year during July and August 2025. These big national projects kept ticking over, providing that essential ballast.
Now, one thing that really stood out, and this is crucial for you listening to understand, is how uneven demand was across different segments. The reports are pretty clear. Rural demand seemed to hold up much better, maybe even outperform urban demand this quarter.
Yes, and there are some solid reasons behind that rural strength. Three key factors, really, all linked.
Okay, what are they?
First, we generally had an above-average monsoon across large parts of the country. Good rains mean good harvests, which means better agricultural income.
Right, fundamental for the rural economy.
Second, this was actually the fourth quarter in a row where we saw positive real wage growth for rural laborers. That means their earnings are increasing faster than inflation. They have a bit more cash in hand.
And what do they do with that extra cash?
Often it goes straight into home improvements, repairs, maybe adding a room, or crucially, upgrading from a temporary kacha house to a more permanent pucca structure using cement and bricks. Small, incremental projects, but they add up.
Okay, so monsoon and wages, what's the third factor?
That links directly to government support. The minimum support price, the MSP, for Kharif crops was raised by a decent margin, about 5 to 10% for the FY 25-26 season.
So the government guarantees farmers a better price for their produce.
Exactly. That injects cash, but also confidence into the rural economy. It encourages farmers to invest, maybe build better storage facilities, or just spurs that general local building activity we talked about.
Now, contrast that fairly positive rural story with urban demand, which the reports say continued to lag behind. Is that just about high interest rates hitting housing, or is there more to it?
It's mainly driven by a slowdown in new housing projects being launched. We saw that start in Q1 of FY26, and it seems to have carried over into Q2. High interest rates are definitely a factor, particularly for affordable housing.
Right.
Now, there's hope, of course. Analysts think the GST cut might eventually give affordable housing a much-needed boost by lowering overall construction costs. And if interest rates do come down later in the financial year, as some expect, that could spur activity too. But for Q2 itself, yeah, the urban demand engine was definitely sputtering compared to rural.
Okay, but here's where we need to inject a note of caution, something flagged quite clearly in these reports. Looking a bit further ahead. It's about the difference between project announcements and actual project awards. Government tender announcements basically saying, we plan to build this, are still running really high, over 3.5 trillion rupees per quarter. Huge numbers.
That's impressive, yeah.
But the actual contracts being awarded, the work actually starting, that number dropped sharply. INRA reported a 37% year-over-year decline in project awards in Q2, down to only 1.2 trillion rupees.
Wow, that's a massive gap. 3.5 announced, only 1.2 awarded.
Exactly. And that disconnect is a potential red flag for the second half of FY26.
What does it imply? Execution delays, bureaucracy.
Could be a mix of things. Slowdown in execution, maybe bottlenecks in getting projects cleared and finances sorted. But the key concern is the impact on cement demand later in the year. The road sector in particular, which is a massive cement consumer, saw the biggest drop in awards.
Okay, so if fewer contracts are being signed now, that means less cement will be needed for those projects down the line, maybe towards the end of FY26 or early FY27.
Precisely. If this trend of low award conversion continues, those optimistic hopes for a really strong H2 recovery might face some headwinds from weaker non-trade demand. It's definitely something we need to keep a close eye on, that award conversion rate.
Okay, so shifting gears from volumes to pricing. This was obviously a huge focus in Q2, with the market cooling off seasonally and this major policy change, the GST cut, landing right at the end of the quarter.
Right. And the headline is that pan-India prices did soften a bit quarter over quarter. Most reports suggest a slip of maybe 0.5% to 1.5% compared to Q1.
Which is pretty normal for the monsoon quarter, to be fair. Demand dips, so prices usually ease off a little.
But this time, it was also probably companies starting to factor in or pass on some of that anticipated GST relief even before the official cutoff date.
Very likely, yes, especially towards the end of the quarter. But here's the crucial point. Despite that small dip compared to the previous quarter, prices were still expected to be significantly higher than they were in Q2 of last year.
The year-over-year comparison again.
Exactly. The estimates suggest prices were up around 5% YoY compared to Q2 FY25. And that's not an accident. It reflects the fact that the industry had managed to establish better price discipline and a higher baseline price level earlier in FY26, coming out of that damaging price war last year.
So they held on to some of those gains. What sort of level are we talking about?
Axis Securities put the Q2 FY26 All India average price somewhere in the range of 350 to 365 rupees per bag. A pretty solid level, all things considered.
Okay, now let's really dive into the big structural event, the GST rate cut. Effective September 22nd, dropping from 28% down to 18%. That sounds like a massive change.
It is massive. Structurally, it's a huge positive for the entire construction ecosystem.
Yeah.
Think about it. That 10 percentage point drop translates to a potential reduction in the tax burden of around 30 to 35 rupees per bag of cement.
Wow, 30 to 35 rupees. That's substantial when you're buying thousands of bags for a project.
Yeah, absolutely. It's fundamentally deflationary for construction costs. And what the channel checks are showing is that the cement companies are, by and large, passing most of this benefit on to the end consumer.
So prices at the retail level or for bulk buyers should come down quite noticeably.
They should. And for every 30-odd rupees saved per bag, you can imagine the impact on large infrastructure projects, roads, bridges, metros, which consume cement in enormous quantities. It makes a real dent in their total project cost.
So if overall construction costs fall, what are the knock-on effects the analysts are expecting? What does this unlock?
Well, the hope is primarily twofold. First, it could finally provide a real stimulus to the affordable housing segment. That part of the market has been really subdued, largely because costs were just too high for developers and buyers. This cut makes those projects more viable.
Okay, so potentially reviving affordable housing. What's the second effect?
It's about consumer behavior. When the effective price of branded cement comes down, it makes it more competitive against cheaper, often lower quality, unbranded local cement or other building materials. So it encourages consumers, individuals building a house, small contractors, to maybe upgrade to a better quality, premium branded cement.
So it benefits the bigger established players with strong brands.
Right.
Like the Dalai Master example you mentioned for Star Cement.
Exactly. It pushes the market towards quality and formal players.
But yeah, structurally positive in the long run. Does it cause any short-term pain or confusion as companies adjust? How does it actually affect their own revenue, their realizations in the immediate term?
Yeah, this is where it gets a bit tricky in the near term. It definitely introduces a period of uncertainty for the next few months, say through Q3. As companies pass on the benefit, market prices are likely to remain flat, or maybe even face some downward pressure while the market absorbs this change. Now think about it from the company's perspective. Even if their base selling price before tax stays the same, they are now collecting less tax because the rate is lower. So the net amount they receive after remitting the tax, their net realization might not actually go up. It could remain pretty much range-bound for a while.
Got it. So the benefit flows mostly to the consumer, not immediately to the company's bottom line.
In this initial transition phase, yes, and this temporary sort of pricing friction, let's call it, it does pose a potential downside risk to some of the more optimistic earnings forecasts that analysts might have put out for FY26 before the full impact was clear.
So that structural shift adds one layer of uncertainty, and then you've got the usual suspect. Intense regional competition, which makes pricing even more volatile.
Yeah.
The reports mentioned quite a bit of variation across the country in Q2.
Oh, absolutely. Competition is always fierce, but it plays out differently region by region. The South, almost predictably, saw the sharpest price declines quarter on quarter, down by about 10 to 15 rupees per bag, according to some checks.
Why always the South?
It just has the biggest imbalance between supply and demand. There's a lot of capacity concentrated there, so it's perpetually a buyer's market, prone to price wars. The East also saw some softening, likely due to the extended monsoon hitting demand hard there.
And where were things more stable?
The North and Central markets held up much better. Prices were relatively stable, with the North maybe even seeing a tiny fractional increase, like 0.3% QOQ, according to one report. It just highlights how you really need to understand the local dynamics. A pan-India average can hide a lot of regional pain or resilience.
And this competitive pressure seems pretty relentless. Analysts noted that even in September, when companies tried to push through a price hike, maybe 10 or 20 rupees a bag, it just didn't stick. It failed completely. What does that failure tell us?
It tells us that the underlying competitive intensity is still incredibly high. It's basically overriding any potential breathing room that the GST cut might have theoretically offered companies on the margin front.
Why is it still so intense, even after last year's pain?
Two main reasons highlighted. One, there's still significant new capacity being added across the industry by various players. More supply chasing demand always puts pressure on prices.
Right.
And two, the market leaders, particularly those who have made acquisitions recently, are focused on ramping up the utilization of those newly acquired plants to capture cost savings and synergies. That means pushing volumes, which adds to the competitive heat.
So no easy path to higher prices then?
Not immediately. Systematics, for instance, suggested that dealers aren't really expecting any meaningful, sustainable price hikes until after the Diwali festive season, probably looking towards early November when construction activity seasonally picks up again.
Okay, this is fascinating. Volumes were okay-ish, but not great in Q2. Prices were soft compared to Q1. Yet, we keep coming back to that prediction of a massive 50 to 70% year-over-year surge in EBITDA per ton. So if it's not volumes and it's not sequential price hikes, the answer has to lie on the cost side, right? It must be about favorable input costs.
Absolutely. That's the engine driving this huge YoY profitability rebound. The cost environment has been remarkably benign, especially compared to the inflationary pressures we saw a year or two ago.
Let's break that down. What are the key costs? Fuel is a big one, right?
Huge. Fuel, mainly coal and petcoke, can easily account for 25, maybe 30% of a cement company's total operating costs. And the news here has been consistently good. For the companies covered, the overall fuel cost per ton is estimated to be down about 7% year over year in Q2 FY26.
Okay, 7% down. What drove that?
Well, imported coal prices, which are a major benchmark, stayed relatively soft. They hovered around the $100 per ton mark, which is quite manageable.
And pet coke, that's often used as well.
Petcoke, yeah, it's favored for its high energy content. It did see a slight increase, maybe moving from around $110 to $120 per ton. But overall, the intense pressure from soaring fuel prices that plagued the industry in FY24 and early FY25 has completely evaporated.
Now, the reports gave a really useful sensitivity number, which helps understand the impact of these fuel price moves. They said a $10 change in the price of either imported coal or pet coke can swing operating costs by 30 to 40 rupees per ton.
How significant is that, 30, 40 rupees?
Oh, it's hugely significant. Let's put it in context. Remember we said the average price per bag is around 350, 365 rupees?
Yeah.
A ton of cement has 20 bags. So a 30 to 40 rupee swing per ton translates directly to about 1.50 to 2.0 rupees per bag.
Okay, 2 rupees per bag.
Now, if a large efficient player is making, say, a net margin of maybe 100 to 150 rupees per bag, that 2 rupee swing represents a noticeable chunk of their profitability. Having stable, predictable fuel costs is incredibly valuable for planning and maintaining margins.
Right, so lower fuel costs are a major factor. What about other operating costs? Overall, the trend was favorable there too. When you factor in slightly lower logistics costs maybe and ongoing efficiency measures, the total operating cost per ton for the coverage universe is estimated to have declined by about 1% year over year. Not dramatic, but moving in the right direction.
Okay, so fuel costs down significantly YoY. Overall costs down slightly YoY. And that sets the stage for the big headline number. Let's just repeat that estimate again. EBITDA per ton surging by 50%, maybe even up to 70% year over year.
Yeah, the numbers are dramatic, but again, we absolutely have to contextualize this. To understand why the jump is so massive, you have to remember just how bad Q2 of FY25 was.
The low base effect.
The extreme low base effect. That quarter last year was marked by absolutely devastating competitive intensity. Companies were locked in a brutal price war, fighting desperately for market share, and margins just collapsed.
How low did they go?
For many players, even large ones, EBITDA per ton fell into a really inefficient, frankly unsustainable range, sometimes as low as 625 to 780 rupees per ton. Just incredibly thin margins.
Wow. Okay, so compared to that, getting back to a more normal level of profitability looks like a gigantic leap.
Exactly. The 50 to 70% surge this year isn't really about extraordinary performance now. It's more about climbing back towards operational normalcy, escaping that incredibly painful base period from 12 months ago. It's a recovery story.
So it's driven largely by cost normalization, fuel prices coming back down, and the fact that they managed to establish some level of pricing discipline in the first half of this financial year, FY26.
Precisely. Those are the key ingredients for the Yoway recovery.
But, and there's always a but in this sector, it seems. While the year-over-year story is fantastic, the sequential picture comparing Q2 this year to Q1 this year is much less rosy.
Ah, yes, the QOQ reality check.
EBITDA per ton is actually expected to have declined quite sharply from Q1 to Q2, maybe by 17%, up to potentially 29% for some companies. Why such a big drop sequentially?
This is where we need to talk about operating leverage, or in this case, negative operating leverage.
Okay, explain that.
It's purely down to seasonality and operational factors. Cement plants have significant fixed costs, things like depreciation on the plant, management salaries, minimum power charges, basic maintenance crews. These costs are there whether you produce 1 ton or 1,000,000 tons.
Right, they don't change much with volume.
Exactly. So in a strong quarter like Q1, when volumes are high, those fixed costs get spread over a large number of tons, making your cost per ton look good. But in a weak quarter like Q2, when volumes drop significantly due to the monsoon, and companies also take advantage of the lull to schedule necessary maintenance shutdowns.
Those same fixed costs get spread over much fewer tons.
Precisely. Which pushes your cost per ton up, dragging down profitability compared to the previous quarter. You lose the efficiency that comes from running the plant flat out. It's an expected seasonal dip, a speed bump, but it explains that sharp QOQ decline.
Got it. So Yo-Yo looks great due to cost normalization and base effects. QQ looks weak due to seasonality and negative operating leverage.
That's the picture.
Now, this volatility, the painful memory of that Q2 FY25 price war, the constant cost pressures, it seems to be driving a conscious change in strategy among the bigger cement companies.
Yes, the reports definitely pick up on this. There seems to be a deliberate pivot happening, particularly among the large incumbents.
A pivot away from what and towards what?
Away from purely aggressive, volume-led strategies. You know, the old approach of grab market share at almost any cost, even if it means sacrificing margin.
Right, the slash and burn approach.
Towards what they're now calling value-driven growth.
Okay, what does value-driven growth actually mean in practice?
It means prioritizing profitability over just chasing volume. So focusing on achieving better price realizations, improving the product mix by selling more premium cement, which carries higher margins, and maintaining strict cost discipline. They seem more willing now to potentially sacrifice a little bit of market share here and there if it means protecting their margins.
So a shift from quantity to quality of earnings, in a way.
That's a good way to put it. And this pivot is seen as really crucial for supporting more sustainable, less volatile profitability in the medium term, especially given the competitive pressures we've discussed.
Okay, let's try and make these broader trends more concrete. It's always helpful to look at a specific company. Star Cement is mentioned quite a bit in these reports, particularly their focus on the Northeast. It seems like a good case study for how some of these strategies, regional focus, expansion, efficiency, play out on the ground.
Absolutely. Star Cement and the Northeast market are a fascinating example. The Northeast is strategically very important because it's expected to grow much faster than the rest of India on average.
Why is that?
2 main reasons. First, there's a massive amount of government infrastructure investment pouring into the region. We're talking huge road projects plans for over 14,000 kilometers, costing something like 2 lakh crore rupees, plus big railway upgrades, airports, hydropower. The scale is enormous.
So a huge infrastructure demand pull. What's the second reason?
Relatively low existing cement consumption per capita compared to the rest of India. There's just a lot of catching up to do in terms of basic housing and development. So you have both organic growth potential and this big infrastructure kicker.
And Star Cement is right in the middle of this.
They are the dominant player. They're the largest cement producer in the Northeast with something like a 27% market share. And that leadership position is quite well protected.
How so?
By pretty high natural entry barriers. The terrain is difficult, logistics are challenging, land acquisition isn't easy. It's not a simple market for a new player to just walk into and set up shop. It gives incumbents like Star a significant advantage.
And does their performance reflect that leadership?
It certainly seems to. In the last financial year, FY25, Star Cement apparently grew its revenue in the Northeast by over 8%. Which sounds okay until you compare it to the overall industry growth in the region, which was almost flat, just 0.3%.
Wow. So they dramatically outperform the market. They're not just riding the wave, they're creating it almost.
Yeah. It looks that way, yeah.
Yeah.
They're clearly capturing the growth opportunities very effectively.
And they're not resting on their laurels either. The reports highlight a really ambitious capacity expansion plan.
Extremely ambitious. They just commissioned a big 3.3 million ton per annum MTPA clinker grinding unit in FY25. And the channel check suggests they ramped that up incredibly quickly, hitting almost 90% utilization very fast.
That's impressive. Shows strong execution and that the demand was really there waiting for it.
It does, and they're not stopping. There's another 2 MTPA grinding unit planned for Silchar, expected by the end of this financial year, Q4 FY26, and then another 2 MTPA lined up for Jorhat in FY27.
So that takes their total capacity up significantly.
Yeah, it pushes them towards 11.7 middle TPA. But what's also interesting is that they're looking beyond the Northeast now as well.
Oh, really? Where?
They're making strategic moves into Rajasthan, primarily looking to secure high-quality limestone mines.
Ah, securing raw materials. That makes sense.
It does two things. It reduces their risk of being overly concentrated in just one region, the Northeast, and critically, it helps future-proof their access to limestone, which is the key raw material for cement production. It's a smart, long-term strategic play.
And this ties back to that idea of value-driven growth too, doesn't it? It's not just about volume. It's about securing the whole value chain. We also see that in their product mix.
Absolutely. They're actively pushing premium products. Sales of their premium cement brands, like that Bale Master we mentioned, apparently surged 85% year over year. It now makes up about 11% of their total trade sales.
And premium products mean better margins, presumably.
Generally, yes. They command a better price and are often less sensitive to the kind of brutal price competition you see in the basic commodity cement segment.
Okay, so strong market position, aggressive expansion, premiumization. What about the cost side? Efficiency.
They're making big strides there too, particularly with green energy. Their goal is to get 55% of their energy needs from green sources by FY26.
How are they doing that?
A key part is waste heat recovery systems, or WHRS. They commissioned a 12-megawatt WHRS plant in FY25, which basically captures waste heat from the production process and converts it into electricity. More capacity is planned. This directly lowers their reliance on expensive grid power or fossil fuels.
Smart. And there are government incentives for this kind of thing too, right?
Yes, big time. They benefit from a subsidy scheme that's equivalent to 200% of their investment in these qualifying assets. And they're apparently working strategically to accelerate earning this cash inflow, potentially getting it back over just 7 years instead of a longer period. That provides a nice, steady, additional cash flow stream.
Okay, so putting it all together for Star Cement in Q2 FY26, how did their estimated performance look? Does it mirror that broader sector trend of strong YoY growth despite QoQ softness?
Perfectly. Even though they, like everyone else, would have seen a sequential dip due to the monsoon, their year-over-year numbers look stellar according to the estimates. Volumes were projected to surge 15 to 18% YoY, strong volume growth. Revenue growth even stronger, around 23 to 24% YoY, likely helped by that premiumization push. And the key metric, EBITDA per ton, estimated to be exceptionally high for them, somewhere between 1,492 and 1,503 rupees per ton.
Wow, that's significantly higher than the general industry levels we were talking about earlier.
It is, and that represents a massive 53 to 54% increase compared to their Q2 last year. So yes, Star Cement really encapsulates that broader story. Disciplined costs, smart expansion into a growth market, premiumization, all leveraging that cost normalization trend to deliver huge profit gains compared to the very low base of Q2 FY25.
Right, so we've dissected Q2. We understand the seasonal weakness, the GST impact, the cost story, the massive YoY rebound. It was, as we said, maybe a strategic step back before hopefully leaping forward in Q3 and Q4. So what is the outlook? What are the longer-term projections saying for the rest of FY26 and into FY27? Is this profitability sustainable?
The general consensus among the analysts seems pretty bullish, actually. Looking out over the next couple of years, they're forecasting overall cement demand in India to grow at a pretty healthy clip, maybe a 6 to 8% compound annual growth rate, CAGR.
Okay, 6 to 8% growth. What's driving that sustained demand?
It's really a continuation of the trends we've discussed. That triad of factors. Sustained government spending on infrastructure remains key. Then there's the potential for a revival in private housing, especially affordable housing, thanks to the lower GST rates making projects more viable. And thirdly, accelerating activity in commercial real estate offices, warehouses, etc.
So multiple demand drivers firing.
Hopefully. And the scale of anticipated growth is just enormous. The projections suggest India is set to add an absolutely unprecedented amount of new cement capacity, somewhere between 150 and 200 million tons by FY28.
Whoa, hang on. 150 to 200 million tons of new capacity. That sounds huge. Doesn't that completely contradict this new strategy of value-driven growth we were just talking about? Won't that massive influx of supply just inevitably lead to another round of brutal price wars?
You've hit on the absolute core tension for the sector's medium-term future. That's the multi-billion-dollar question, isn't it?
It seems like a massive risk to profitability.
It absolutely is. And that's precisely why the focus on efficiency and consolidation is now so critical. The bullish case relies on those positive demand drivers, infra, housing, lower taxes, working together with what analysts see as structural tailwinds.
Which are?
Primarily ongoing industry consolidation. As bigger players acquire smaller ones, you tend to get better overall supply discipline and more focus on profitability rather than just volume. Plus, those continuous efficiency improvements like the green energy initiatives, logistics optimization, those are expected to help companies absorb some of that new capacity without completely destroying pricing power. The hope is that margin recovery can resume from FY27 onwards.
It sounds like a delicate balancing act.
Very delicate. Adding that much capacity without triggering price wars will require incredible discipline from all the major players.
Okay, let's talk more explicitly about the risks then. Beyond just the overarching supply issue, what are the key structural threats that companies like Star Cement and the industry as a whole need to manage carefully? The reports outlined a few.
Yeah, they generally boil down to three main categories. Let's maybe go beyond just listing them and think about how they actually work and what the mitigation strategies look like.
Okay, first up.
Competition risk. This is ever present. It's constantly being intensified, not just by the existing large players expanding aggressively, but also by smaller regional players, and always the looming threat of new foreign entrants deciding India looks attractive.
So how do you fight that? Just cut prices?
Well, that's the old way. The value-driven approach suggests other tactics. One key strategy is geographical diversification. We saw Star Cement doing this, moving into Rajasthan. It spreads their risk, stops them being overly reliant on the fortunes of just one region, and potentially gives them access to new growth avenues.
Right, don't put all your eggs in one basket.
Exactly. And the other key mitigation is building brand loyalty through aggressive promotion and marketing so customers choose you for reasons other than just the absolute lowest price.
Okay, competition risk. What's the second major category?
Input cost risk. This relates directly to the raw materials. The industry is incredibly dependent on just two key things: limestone and fuel, primarily coal or petcoke.
And the risk is availability or price volatility?
Both. Consistent availability of high-quality limestone is crucial, and we've already seen how volatile fuel prices can be. So the mitigation strategies here are twofold. First, vertical integration, trying to secure your own limestone supplies by acquiring mines, like Star is doing in Rajasthan.
Control your source.
Right. And second, for fuel, it's about diversifying your sources. Continuously exploring alternative fuels, maybe lignite, maybe using more waste materials from other industries as fuel, anything, to reduce that complete dependency on, say, volatile international coal markets.
Makes sense. And the third big risk area?
Transportation risk. Cement is a bulky, relatively low-value commodity. Moving it long distances is expensive, especially with high fuel prices in India.
So logistics costs can eat up your margin very quickly.
They absolutely can. Transportation can easily be up to 20% of the final landed cost for the customer. So the risk is that high diesel prices, for example, make serving customers far from your plant simply uneconomical.
How do companies mitigate that? Build plants everywhere?
Not necessarily feasible. It's more about sophisticated logistics management. The reports mention things like stock on wheels services, basically using technology to optimize how they use rail and road networks, minimize empty journeys, reduce transit times and costs.
Smart logistics.
Very smart logistics. Plus, investing heavily in optimizing their network of warehouses and distribution points. And crucially, strategically locating grinding units, which turn clinker into cement, closer to the major consumption centers, rather than having everything centralized at the mine. This reduces that expensive last-mile transportation cost.
Okay, so a multi-pronged approach to managing competition, input costs, and transport risks. It sounds like they're actively working to protect those margins they've managed to recover.
They have to. The memory of those price wars is still fresh, I suspect.
So, wrapping all this analysis together, the Q2 performance, the outlook, the risks, the strategies who do the analysts actually like right now. If
Yeah.
you synthesize the recommendations from the different brokerage reports, where does the consensus seem to lie? Who are the top picks?
Well, if you're looking at the established industry giants, the large caps, there's a very clear preference. Ultratech Cement comes up again and again as a top pick, or a strong BUY recommendation from ICICI, Axis, Systematics, pretty much across the board.
Why Ultratech?
Just its sheer scale, its proven operational efficiency, strong pan-India presence giving it regional balance, and its track record. It's seen as the bellwether. Ambuja Cement is also highly rated, specifically flagged as a top pick by Systematics, likely reflecting renewed optimism around its expansion plans under its new ownership.
Okay, so Ultratech and Ambuja for the large caps. What about further down the scale? Mid caps or strong regional players who might offer more growth potential, perhaps benefiting from specific trends we discussed.
There are a few consistent names there, too. JK Cement is highlighted by both ICICI and Axis as a strong choice in the mid-cap space. They're known for good, consistent plant utilization and maintaining decent pricing discipline.
Right.
Star Cement, our case study, obviously features prominently. Rated BUY or ADD by Axis and ICICI, clearly validating their strong position in the fast-growing Northeast. And one other name that popped up was Nuvoco Vistas, listed as a BUY by Systematics, likely based on their recent capacity additions coming online and perhaps a more attractive valuation currently. #, Outreach.
Okay, this has been a really insightful deep dive. We've peeled back the layers on Q2 FY26 for the Indian cement sector. I think for you listening, the key takeaway has to be understanding those optics, that short-term weakness we saw in Q2, driven by the monsoon, driven by that temporary GST friction. It was almost a necessary pause, but it was fundamentally overridden by more powerful forces. The normalization of input costs compared to last year, that relentless government infrastructure push, and this apparent commitment from companies towards a more value-focused, margin-protective strategy.
Yeah, the foundation seems to be firming up. Profitability bounced back strongly year over year, mainly off that low base, but it sets a much healthier stage for the second half of FY26.
The industry seems to have navigated that rough patch
Yeah.
and is now really focused on efficiency, consolidation, and trying to build sustainable margins rather than just chasing volume at all costs.
That strategic pivot, moving away from the volume wars, is absolutely intended to be their main defense against future volatility.
Right. So let's end with that final provocative thought for you to consider, connecting that strategic intent with the big looming reality we discussed, drawn directly from these sources.
Your capacity question.
Exactly. The Indian cement sector is forecast to add a truly unprecedented 150 to 200 million tons of new capacity by FY28. That is a potential supply tsunami. So the question is, how will this relatively new corporate commitment to value-driven growth, prioritizing margin over volume, actually hold up when faced with that massive increase in competitive supply? Can they maintain discipline? And what will the real impact be on long-term pricing power once seasonal demand fully returns and all this new capacity starts competing for orders, say in FY27 and beyond?
That tension, the sheer volume of new supply versus the stated strategic discipline of the major players, that's going to be fascinating to watch. It will really determine whether this sector becomes a consistent long-term value creator or slips back into being just a volatile, cyclical commodity play.
A critical question indeed. Thank you for joining us on the Deep Dive.
Thanks for listening.
We'll see you next time.